As far as the markets go, we are all glad to see September go, but will October be any better? That's the subject of today's Fastest 4 Minutes in Finance. Hello again, I'm Scott Inman. Well, we took the week off last week and we transitioned into our new studio. We hope you enjoy the new look. And we'd all probably like a new look for the market returns after a dismal September. You may remember we talked about the historical weakness of this month a few weeks back. It turned out to be the case. The S&P 500 was down 3.7% for the month, and 9 of the 11 sectors that make up that index were down. Only financials and energy were positive for the month. I think we are all ready to welcome in October. Now, leaving the market talk for just a minute, this might be my favorite month of the year. Fall is definitely my favorite season in Arkansas. I love the warm days and cool nights. The leaves are starting to change. College football hits its stride. The baseball playoffs are underway. I love just getting outside, hiking, building fires at night, and just soaking it in. I'd love to see market returns add to that enjoyment. But will they? It is important to have some long-term perspective here first. Even though September was negative, the S&P 500, the Dow Jones Industrial, the NASDAQ, and the Russell 2000 are all positive by double digits year to date. But there is no doubt that headwinds are mounting. And for the first time in 18 months, it's not just the COVID-19 pandemic that we're talking about. Bond yields are going up. That's putting pressure on highly valued, rate-sensitive NASDAQ composite equities. Washington's debt ceiling debate is at least a temporary catalyst for short-term volatility. But we believe corporate earnings are the fundamental driver of long-term market growth. And even that could be cooling off from its red-hot pace. Strong earnings have driven the stock market performance for the past 12 months, and earnings in the second quarter of this year were record-setting. Third quarter earnings season begins in the next couple of weeks, and we should see if inflation, a continuing labor shortage, and supply chain disruptions affect the numbers. The ability for companies to absorb higher input costs and pass them on to their consumers will play an important role in future earnings results. And finally, a couple of notes from the Federal Reserve meetings in September. The Fed has reduced its GDP expectations in 2021 now, from 7% to 5.9%, still really good growth. And the Fed expects much higher inflation, with headline inflation at 4.2% and core inflation at 3.7%. However, the committee does see inflation falling slightly in 2022 and has raised its economic growth forecast for the next year as well. So the takeaway here is October may not be a direct turnaround from September, but if the economy can ride out a few bumps in the road, the bull market could have a lot more growth ahead. Thanks for watching.